I'm Paul Groh, Director of the Estates Administration Department at the Law Offices of Daniel Hunt. They say that the only certain things in life are death and taxes. But did you know that dying doesn't excuse you from paying taxes? It's true. When a settlor of the trust dies, the successor trustee is responsible for handling the decedent's unfinished tax business. In total, there are 4 main types of tax returns that the trustee has a responsibility to prepare and file. The first is the decedent's final tax income return. As a trustee, you'll be responsible for filing the decedent's final tax return and paying any taxes due. If the decedent was married and the surviving spouse is still alive, consult with a CPA about possibly filing a joint return with the surviving spouse if this would be beneficial for the estate. Second, final income tax returns for the estate. As trustee, one of the last tasks you will likely perform in your role is filing the final tax return, or Form 1041. Form 1041 asks the trustee to report the income and deductions of the trust, the income that is either being held for future distribution or currently distributed to the trust beneficiaries, any income tax liability of the trust, employment taxes on wages paid to household employees, including the trustee. In general, beneficiaries will be taxed on any paid income or distribution they receive from the trust, while the trust is taxed on retained income. If the trust has income exceeding $7,900, it will be taxed at the maximum federal rate of 39.6%. If this is a concern, you may wish to consider distributing income to the beneficiaries before the estate is closed, since they will ultimately be receiving it anyway, and this could save the estate money. Third, the federal estate tax return. If the gross estate exceeds $11.7 million in 2021, then the trustee will need to file a Form 706 tax return. As trustee of the trust, you are personally liable for filing the estate tax return and paying any tax due. When you file your return, you can protect yourself from this liability by requesting early determination of the tax and discharge from personal liability. Fourth, generation skipping tax return. Trustees must report generation skipping transfers and pay any taxes due. A skip person is someone who is 2 or more generations below the transferor, most commonly the transferor's grandchild. If the decedent made any direct skip transfers before they died that were not previously reported, then the trustee must file a Form 709 tax return. If any generation skipping transfers are occurring after the decedent's passing under a trust, the trustee must also report those on a Form 706 tax return. An important tip on determining final tax liability. Even if you don't believe that the final Form 1041 will have any income tax liability, there may still be outstanding tax obligations. This could come from a prior year's tax return, a state or local government, or even unpaid real estate taxes. In order to determine the trust's final tax liability, be sure that you have completed returns for each year of administration and that you have no knowledge of any open issues regarding any of them. Before making any distributions to the beneficiaries, be sure to set aside a reserve account with sufficient funds to cover any taxes you think the trust may owe and cover the CPA fee. If you plan to file a short year tax return, before terminating the trust, you will need to ensure that it has reached 0 taxable income and 0 tax liability. If the trust terminates before the end of a calendar year, you may consider filing a short year return. A short year return can be useful when closing out a trust administration, because for most people, you'll probably be ready to complete the trust administration before December 31st, making it a short year for tax purposes. A short year return allows you to complete the trust administration sooner than if you waited out the full remainder of the year. You prepare a short year return as you would any other return, with 2 differences. First, you should fill in the dates of the short year at the top of the return. If the current year's form isn't available yet, you may use the prior year's tax form and superimpose the correct year over the printed prior year. Don't forget that a short year return is still due 3.5 months after the end of the year date you've chosen. So if you choose to end the year on June 30th, your short year return would be due on October 15th. If you have any questions about preparing tax returns as a trustee or like a referral to a skilled certified public accountant, please contact our office. We hope this video has been helpful, and if you have any questions about estate administration, feel free to contact the law offices of Daniel Hunt using the information listed below. Thanks.